Now, in this segment, we're gonna pivot and we're gonna talk about the U.S. refined products and more specifically on where's demand. Do we have more tailwinds, headwinds, and obviously price is going to be a factor, especially when you start looking at people who are planning. And we have a bit of that lull period because we had Easter, we had spring break, and now we don't have too much going on. And then Memorial Day is really when you kind of kick off that driving schedule. And the question is going to be, where are we in that process? So we kind of have this lull, and then we want to see where this pivot goes. So when we look at what's happening in the U.S. right now, the current demand side, we're at 14.192 million versus last week, which was 14.542. So you can see we're still at the very low end of that 14 million side. But it's 14 million barrels per day. But when you look at where we should be right now, looking at 17, 18, 19, we should be between 15 and 15.5 million barrels a day of that demand front. And it's just we're not closing the gap on the airline side. We're seeing some of that weakness on the gasoline front, and that's something that we think is going to persist. And then diesel is seeing a lot of headwinds in terms of demand, not because of price, because demand is coming down. The problem is supply continues to be at a very low number. So even though you're seeing some of that softness on the demand side, supply is going at a faster rate, where gasoline, globally speaking, you're getting builds, but in the U.S., we've had some of that drop, but we're not seeing the same pickup in demand. But again, that drop in supply is helping to kind of boost those prices, keeping us where we are. So we don't see much of a pivot from here. And if you look at the numbers right now at that 14.192 million, it's actually the lowest it's been since 2020. It just slightly took out the low that we had at the same period for 2021. So again, you're starting to see those cracks, and then this is, remember, last week. So when you look at this week and you look at the new surge in gasoline prices, it's not going to aid the current demand structure. So European imports of refined fuels from the Americas are poised to decline in May. So they did go to a 19-month high, and it's just because the margins were too good from PADD 3 into Europe. So we did get a lot of gas oil, a lot of that distillate coming through, and we are getting that drop in diesel just because now Europe is taking a lot from the Middle East. We've seen those flows continue. Same can be said for India. So as those show up, there'll be a little bit less demand for the U.S. Product, which will put a bit more in storage. But again, it doesn't mean that's going to stop pricing. Maybe it just stops prices from going up, like the rate of change, but there is a lot to keep prices where they are currently. So then when you look at where distillate is, here's that drop of 910,000 barrels. When you look against the 5-year average, that's 31.4 million below the 5-year. A large part of that, as we've been saying, is driven by PADD 1. PADD 1 had another draw of 1.07 million, and that's 21.6 million below the 5-year average. There's the availability concern is real, especially when you're looking at the Eastern Seaboard. Other areas are low, obviously against the 5-year, but still they're 4 million below the 5-year, not 21 million below the 5-year, which is why we continue to see the problems really picking up in that PADD 1 side on that East Coast. So that's where we continue to see those issues. Now, when you look at imports, as we've been saying, we do believe they'll remain a bit elevated, but elevated in the sense of just, holding just above that 5-year average, not seeing a huge shift in terms of where some of that is moving, how that is moving, and where that is going in general. So then when you look at distillate against the 29-year average, here you can see where those different shifts are. Typically on the 29-year average side, we normally have kind of flatlined. We're starting to see the rate of change move back up, and we just are continuing to see this steady grind down. Now, a lot of that was also driven based on the extra exports going from PADD 3 into the international market. As that slows a bit, you'll see some of that flatlining, but unless we get a bigger step up in refinery utilization rates, it's going to be hard to see this not continue to be at a very bullish side. And if you look at the bottom of that cloud, it continues to go up because typically we're building at this point. And so if you think about if we just flatline, we're still coming into a tougher spot because the comps are getting worse and worse as we should be on an increasing side. Now, when we look at distillate stock, when you look at on the production side, production increased 162,000 barrels a day. We had an increase in yield on the disty side by about 60 basis points, and that's something that we think is going to continue. So we'll have distillate staying at about 31% of the cut. We'll have a slowdown in exports. We'll have a slowdown in local demand, which again should be enough to kind of flatline us and get some of these builds coming back through, but nothing crazy in terms of builds to rectify this. Now, here's what we've been talking about on the demand side. We've seen that slowdown. We think at this point here we're going to be just either at the 5-year average or just below. And the reason why is because, again, we're seeing that big drop off in trucking demand just based on price. So here, one of the things that we were saying, we were going to stay between that 95 to 105, maybe a 115 level. But 95 to 105 is where we're starting to see that come through. Truck availability continues to increase, so there's more competition. There's more things coming through. The load availability, again, off the highs, but still elevated. When you look over the last 8 years, there's still a lot of demand. It's just not what it was in 2021. So when you look at those comps, so when you look at the numbers that we had at the beginning of the show, 2021 was supported by that diesel number. Now you have that diesel kind of giving way, showing a bit more of the cracks that we've seen in gasoline, and that's why we think we're going to stay a bit lower, especially when we compare it to last year. But regardless, when we look at trucking side, here's where we see some of these headwinds. This is some of the stuff that we think is going to be a bit problematic. Now, when we look at rail traffic, you can see that car loads picked back up. We're only 1.9% below this week last year, and coal continuing to be strong. We don't see that stopping. Grains, again, there's the harvest is a problem. We're continuing to see a very light harvest. The weather is just prohibitive in terms of yield. We've had some a lot of drying out. And then actually some of the wetness prevented in other areas prevented some of the planting. So again, we're having some of these problems when you look at the drought side. And then motor vehicles had a big increase. That's something that last year the comps were much easier. That's something where the comps are much easier. And then intermodal continues to be well off the norms and 4.9% below normal. And that's something that I should say 4.9% below last year. And last year's comps, were a little bit easier, especially because of all the issues that we had in terms of volume. So that's something where we continue to be a bit below on the total traffic side, and a lot of that is the intermodal cargo. The vessels showing up continue to be well below last year. It's only going to get worse as we go into June because of the lockdowns. There's that sailing time issue in terms of anywhere from 6 to 8 weeks, depending on distance, depending on where we're talking about, from to the Chinese ports into the U.S. ports, more specifically the West Coast. So that'll continue to be a negative move. And as that comes down, there'll be a little bit of a time to clear some of the glut that we have within the U.S., get some of these cargoes, free up space, because as the China reopens, there's going to be that backlog that's going to hit the water, and we're going to have to be able to manage that surge as it comes through. Temperature shifts, you see that in the Northeast, we're slightly above normal or right at normal. Things get much warmer when you look to the South, and that's what we've been talking about, especially in Texas. And in last week's Insights, we talked a bit about where pricing is, where the issues are. We're going to talk about it again in this week's Insights. When we look at where are grains, where's the harvest, and how thin it is, especially on the wheat side in the South, especially in the Texas region, just because of the pressure in that heating and those just the separation on droughts. Here on the gasoline stock, there was a draw of 3.61 million. That's now 14.1 million below the 5-year average. But when you look across the different areas, globally in the U.S. we're 14.1 below the 5-year, but when you look at PADD 1, we're 14.2 million below the 5-year. So again, you're starting to see where some of those pressures are, which is why we do expect to see an increase in European exports into the U.S. because realistically, the U.S. is a perfect spot for it right now. Excuse me. Now, when you look at PADD 3, PADD 3 had a sizable drop of 1.58 million when you look at what was kind of drawing that gasoline down, but PADD 1 is still 2.6 million above the 5-year average. And that's something that we think is going to hold. Imports had a big drop of 430,000 barrels a day. That's 156,000 below the 5-year. And we did get a little bit of a bump in PADD 3. Sometimes PADD 3 gets one or two cargoes depending on price or what this is being counted as. So we did get an increase of 208,000 barrels a day into 2 weeks ago, which fell off. That's something that won't come back. And then when you look at PADD 1, PADD 1 had a drop of 199,000 barrels a day, but we do expect that to grind higher. And as we get into June, we expect to be well above the 5-year average, just as Europe tries to offload some of that. And the U.S., just given pricing, is going to be a fantastic arbitrage. Now, U.S. imports of European gasoline shrank by 15% week on week in the 7 days through May 5th from a 5-week high in the previous week. So again, some of that ebb and flow, we do expect that to come back through. But when you look at where we are against the last 29 years, you can see that we've had that steady drop. We're tracking that 2019 level. And we do expect to see some of that flatlining at this point as we see some of that come back through. Production on the gasoline front was down about 1%, so we're at about 62.5. And again, this kind of highlights the bigger push of trying to create as much gasoline as possible. Distillate as possible. So right now they're at about 31% distillate and about 62% gasoline. And again, they're going to try to keep that weight towards the disty cut, which is what will inherently put and throw off a bit more gasoline. Now, when you look at that total trend, you can see that it's still having a nice drop in storage, and we have seen exports remain very elevated in comparison to historics, which has been helping some of that move through the system. But you can see here we're right at that 2015-2019 level, and then the next week is when 2019, and it was in 2019 when we had that big spike. The spike is going to, in the U.S. right now for 2022, will be what are exports doing? Exports is going to put that in perspective. I don't see, just based on how low utilizations are right now, I don't see that huge increase, but we could maybe get a bit of a build in gasoline next week, just given some of the shifts on the export market front. And then when you look at mobility, here you can see that China fell again. That's something where we expect China to be average about 93% of normal. When you look at Europe and Americas, you are kind of flatlining at this point. And then when you look at world, just below normal, with a lot of the benefits coming from Asia Pacific. But as we come to the other side of Ramadan, we do expect that to drift a little bit lower, still stay just at about normal, but not be the driver that we've seen. And then TomTom, in terms of the congestion index, you can kind of see where we sit overall from North America. Europe has had a nice rally. We expect that to drop back off a bit and settle right around where we are on the North American front in terms of of the move going forward. Then you look at why. Well, this is going back to 2004 to give you an idea of where prices are. So when you look at the national average for gasoline, for diesel, we are currently at $5.55. So you're seeing a massive surge in terms of pricing. It's well above anything that we've seen so far. And then when you look at unleaded gasoline, we're at $4.40, and something that is, when we look at this, we do expect to see a little bit of a flat line on the gasoline front, but diesel, I mean, I don't see how this doesn't get to over $5.60 at this point. And to be honest with you, $5.60 could happen by the end of this week. I mean, and that's where it just gets compounded when you look at the logistics side, supply chain. because products, raw materials are mined by diesel. The raw materials are moved by diesel. Then they're processed, and that process could be consuming diesel to run the facility. Then it's put on another truck or boat, and that consumes diesel. So again, you're seeing diesel consumption along the way, and that keeps getting padded and added on throughout the different periods. Now, when you look at blending components, you can see here that there is a nice drop right just above where we were in 2019. Blending components had a drop of 4.46 million. That's 11.9 million below the 5-year average. But again, you're seeing something similar to what we saw in 2019. So that'll be interesting to see if we start to get some of that pivot, especially when you look at gasoline demand. So gasoline demand, as you can see here, the comps get harder. And that's where when you see we normally kind of get these spikes, even if we start out a bit sluggish, next week is going to be, or I should say this week, or what's reported next week is going to be an important month because, okay, well, are we going to continue to go flat? Are we going to start to see this bigger surge higher? And one of the things that we've been saying is we expect to just stay in this fairly flatlining pattern, which is going to be a bit damaging when you consider where current demand should be based on price, based on where we are on a seasonal basis, which again is more along the lines of that seasonal pressure and that pricing pressure, because pricing pressure in the U.S. doesn't send demand crashing. It just means that when we're supposed to see an increase, we just don't see the same type of movement higher. And here's where when we start looking at retail, recreation, things are just grinding back up. Weather's getting nicer. Workplace, transit stations continue to be flat. And this is the piece that we've been talking about is as work from home and flexible schedules become more commonplace, that's where you're losing that driving demand. Right now about 20%, we're about 20% below normal, 20% below normal. And how many of those people normally drive and they're not driving? That's preserving the gas that they would normally be expending. So again, those are some of the things that we're seeing, which is becoming a bit more of that new normal in terms of consumption. Propane had a build of 3.41 million. That's only 1.6 million below the 5-year average. You can see that the rate of change has accelerated considerably, getting us much closer to the 5-year average. And a lot of that is because we are targeting more liquids. We are preparing for what we see as a fairly big push into the export market, especially when you think about the cooling, as we come into cooling season, and that's where we're going to start to see a lot of this. And I think this is going to be a good spot to be when you look at some of that margin going out. Days of supply of propane continue. The rate of change is following those builds, and that's something that we think is going to continue at this rate, especially until we start to see a much bigger increase in some of these exports. Jet continues to be right at the low end of our target of that 1.45, 1.55, and we just expect it to be in this level. There was a build of 2.14 million, which is only 2.5 million below the 5-year average. And here's why. When we look at the TSA passengers, you can see that this is typically when we start to see the pivot, where you start to get higher highs, you start to get higher lows, and you start to get this trend up, and then you kind of peak around that, let's just say from July 4th to the first week of August is your peak, and then you start to slow. We're not getting that kind of pivot change. We're just staying kind of flattish and actually seeing, if you look at the peaks, we're actually seeing slightly lower highs, but really kind of the same lows. So it's just where you're starting to see that tighten up a bit in terms of some of those flows. Now, is that because I don't know if you've flown recently, but prices continue to go up. They continue to put pressure, and people are either opting to not go at all, stay local, put off the vacation, or drive somewhere instead. So again, that's where we're also seeing some of those pivots. On the bullish side, passenger flight schedules for the 12 weeks ahead is 0.06 higher week on weeks. Again, that's you're starting to see that. Airlines are starting to plan for that increase, those pushes that we typically have at those peak months when as we get into the middle and end of summer. Open table breakdown, you're starting to see a little bit of pressure coming down when you look at the, before we were 5 to 12% above normal. Now we're at about 0 to 5% above normal, slightly below depending on where we're looking. So again, when you look at the U.S., you've seen some of that pressure to the downside, which has weighed on numbers, which is a bit more in terms of, well, food outside the house continues to go up on an inflationary standpoint, a lot of pressure on wages. So I think you're starting to see that really start to take effect, which is, again, also showing some of the softness in the consumer, which is going to put a bit more of those headwinds on demand, especially on the gasoline front. So that's what we have for you on the U.S. In the next segment, we're going to go a bit broader and look at what were OSPs, how much did they drop, and what does that mean going forward, and where does the international market sit in general.